As we await the next bullish move for the monetary metals suppressed in their derivative Comex complex, aided by the seemingly lawless City of London and its unsecured ETF chicanery complex, now it's time to remind ourselves of eras past and gone, not forgotten. The date of this photo I ripped from Reddit the other day is January 9th, 1978. The spot price of gold that day was $171.60 per troy ounce. You could likely deduce that gold Krugerrands and 50 peso Mexican onza coins were perhaps the savviest gold buy that day, at whatever bullion shop this was. Spot silver was a meager $4.91 an ounce to begin the year 1978. Of course, we're speaking in Fiat Federal Reserve note terms. That day, in the bullion shop, it looks like 100 ounce bars at 500 Fiat Fed notes per bar was the shrewdest acquisition. Within about 2 years' time, under severe stagflation, and even with the corrupt CFTC, a crisis in fiat currency confidence produced a near 5 multiple in the spot gold price and an over 10 multiple for the spot price of silver. The then gold-silver ratio ran from just below 40 into the teens. This time, we're coming from heights closer to 80. I named this week's SD Bullion Market Update as Our Past is Prelude, for real reasons. You don't ramp your fiat monetary base, as we have, without tremendous repercussions. We have, and we will collectively, suffer from this, one way or another. Even the greedy insiders who think they're getting away with it. Bullion is going to account in real terms. And in a few minutes, I'll show you further charts and data illustrating how our past is preparing to rhyme. But first, hello there, this is James Anderson on behalf of SDBullion.com, and this is your SD Bullion Market Update. Before we go further, please smash the like button so other sound money stackers can also see this content. And be sure to subscribe to our SD Bullion channel so you can get our latest market coverages and also a chance at winning incredible bullion giveaways like this one.
You know the drill. SD Bullion is giving away a box of 500 new 2021 Silver Eagles that could have your name written all over it. But if you don't enter, it could go to someone like Silver Steve here. And while we like Silver Steve, he really doesn't like to share. So click the link below for your chance to win.
Click the link below to enter your chance at winning this 2021 SD Bullion Type 2 American Silver Eagle Coin Monster Box giveaway of 500 Silver Eagle coins. Official sweepstakes rules can be found at www.sdbullion.com/sweepstakes. Good luck to all of you who enter and for your chance to win. Silver and gold again had slightly up biases all week. We saw a brief surge above 1810 gold and near 25 spot silver, only to have tamped down algorithmic sell-offs bring the monetary precious metals back in line to close this week. The gold-silver ratio again fell, closing the week at 73. Here's another look at spot gold since the COVID crisis began in early 2020. And now the same chart time frame for spot silver. The coiling is now 15 months running. When will we run and blast through 30? The longer it takes, the higher and more explosive the energy will be, in my opinion. And finally, here is how the gold-silver ratio reacted since the COVID derivative spot price spike. Turning to somehow timing this upcoming manic phase for silver and gold building and likely ahead, I call on the following 3 charts by an over 45-year Comex trading veteran, Michael Oliver, in his Momentum Structural Analysis newsletter. Here we are looking at 10-month rolling averages for monthly closes in silver versus gold. He does this to smooth out the noise of week-to-week volatility. In bullion bull markets, silver often outperforms gold, and so we're looking to find the silver breakout points of the past to perhaps know how far we are from seeing it again. Here in 1980 bull market, there were 2 clear breakout points with a silver short base ripping mania that kicked off in late 1979 and into early 1980. Next, the bull run into early 2011. Here we again see 2 clear breakout points as silver consolidated in the teens for some time in 2010 before tripling in short order. And finally, the run we are likely to get going not long from now. You can see the pandemic breakout as we ran to 30 an ounce, not much time from the 12 spot lows. And of course, we've been consolidating for 15 months since, as I've mentioned. You see the green circle over there on the far right? Michael Oliver and his MSA firm are long silver and also using call options for even more leverage for this coming silver run. And here's how Michael answered me in late 2018 when I asked him where he thought this was all going.
We obviously have valuation bubbles in various asset classes, and even in fiat currency values. I think both you and I would argue we got record global debt levels that keep happening quarter after quarter. Likely is going to be some restructuring ahead. Some will be written off, some may be inflated away. I'd like for you to describe how you believe this coming bull run for precious metals may culminate and how it may ultimately end.
I have not got a price level in mind, except to say I think it's going to be stronger than anything I could come up with. The long-term charts don't give me a clue on that right now. Prior bull market peaks did make some sense where they stopped and so forth, for instance, the 2011 peak. But so I can't come up with the numbers that were going to $10,000 an ounce. I can say that I think that because of what's going on in the other markets, forget gold for a minute, what's going on in the government debt markets, developed market economy debt markets, they've been the most distorted assets over the last 6 to 10 years of any asset I've ever seen manipulated by central banks. And fortunately, if you're a gold bull and you believe, for example, that ignore technicals because, the markets are manipulated. Well, frankly, yes, they are manipulated. We know that. They may even be manipulated in secrecy in some ways as well. But that's what central banks do. They distort prices deliberately. They don't allow the market to determine what price or what yield the Italian bond should be. So the ECB comes in and buys Italian bonds until their yield goes down to some absurdly low level, even below U.S. government bonds. And we all know that's ridiculous.
Right.
Japanese government bonds went to negative rates. We know these things are fake. We know they're manipulated overtly, legally, by coercive actions of central banks. But this time they've done it over such a long period of time, not just a year or so, but 6-10 years. And they've done it to levels we've never seen. It would not have even imagined a decade ago that you could go to, NERPs, negative interest rate, or ZERP, zero.
Right.
That would be laughable. But they did it. And therefore, we know that the distortion was both more absurd than it before and also more prolonged. Therefore, the consequence, the unraveling of that, the accidents that will occur because of that is going to be far worse than it would ever have been. Therefore, gold is going to be powered this time by a greater unraveling than it's ever been powered before.
Billionaire derivative trader Paul Tudor Jones argued this week the obvious. For any of you out there who are trying to make ends meet, the fiat currency devaluation price inflation is the number one threat to all of us now.
The thing that to me is the number one issue facing the man on the street, investors, is inflation. And it's pretty clear to me that inflation is not transitory. It's here to stay. And it's probably the single biggest threat to certainly financial markets. And again, probably, I think, to society just in general. So this 5.4% CPI is a real eye-opener. It's the highest CPI we've had in 30 years. And, of course, it's going to go higher here in the next few months as energy feeds through it. So for an investor in particular, most of this audience, it's absolute death for a 60-40 portfolio, for a long stock, long bond portfolio. So the real question is, how do you defend yourself against it? How persistent will this be? And what does the outlook hold? And there's a combination of structural and cyclical forces that right now are all rolling in the same direction to say that inflation can be much worse than what we fear. So let's just start with the cyclical forces first. We have the demand side of the equation, and that would be M2. M2's grown 5.4 trillion since the pandemic began. That's $3.5 trillion greater than what it normally would have. That $3.5 trillion, 16% of GDP, just sitting in liquid deposits that could go into stocks or crypto or real estate or be consumed. So that's a huge amount of dry powder that's just sitting there waiting to be utilized at some point, which is why inflation's not going to be transitory. So that's the first big, I think, cyclical issue. Also, don't forget, we just raised, another demand factor would be, we just raised benefits for Social Security retirees as well as military, about $75 million by 5.9%. That's just more fuel to the inflationary fire. The second big component would be the wage pressure that we've got. And the easiest way to see that is obviously job offers relative to unemployed. We're 10.4 million job offers, 7.7 million unemployed. It's clear that we have a structural issue in our labor force that's not going to be solved by 0% interest rates and quantitative easing. So if you take those two factors and then overlay the structural issues, and there are four big ones, the structural issues, you really paint a very bleak picture on inflation. The structural issues are, first and foremost, we have a Federal Reserve Board that are inflation creators, not inflation fighters. So and that is a huge, huge deal.
And in real terms, we're not paying this off. And under this inflationary regime, this decade and into the next, bullion is poised to be precious in more ways than one. Position yourselves prudently. That's all for this week's SD Bullion Market Update. And as always, take great care of yourselves and those you love.
If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content.